Hey everyone, welcome back to Corporate Decoder, the place where we might just save you a few bucks by understanding what companies are really saying. Today, we're diving deep into Geospace Technologies, Corporation's latest annual report, a document that is more than just numbers. It is a story of innovation, challenges, and a whole lot of risk. So, Geospace Technologies, they make high-tech stuff for managing water, exploring for energy, and in industrial settings. They've got this cool seismic gear for oil and gas, but they're also pushing into smart water and industrial applications. Let's see how they're doing. First off, the big picture for the year ending the 30th of September 2025, Geospace brought in $110.8 million. That sounds pretty good, but it is actually a drop of about 18% compared to the year before. That might sound like a lot, but it is mostly because they sold fewer of their big ticket items. For example, they had a $17 million sale of these ocean bottom nodes, which are used for seismic data in the sea. Last year, they had a $30 million sale of similar gear. So, fewer big sales mean a lower total. Now, when we look at what actually makes them money called product revenue, it is $104.2 million for 2025. This is down from $116 million in 2024. The main reason for this drop is in their energy solutions segment. That is where they sell their oil and gas exploration gear. Product revenue there fell by over $14 million. They had fewer sales of those ocean bottom nodes and their wireless seismic gear. But it is not all bad news. Their smart water division, the one focused on managing water, actually saw an increase in revenue. It went up by $3.4 million, which is a pretty healthy jump of over 10%. This is thanks to their Hydrocon cable and connector products. People are really starting to see the value in smart water tech. And their intelligent industrial segment, which covers a mix of sensors and manufacturing services, stayed pretty steady, only dropping slightly. Now, let's talk about profitability. Their overall gross profit for 2025 was $32.9 million. That is down significantly from $52.6 million the year before. This is because of those lower sales in energy solutions, and also because their rental business, where they rent out seismic equipment, wasn't used as much. When equipment isn't being rented out, the costs, like depreciation, still hit the books, but the income doesn't come in. And then there are their operating expenses. These went up by about $3.3 million, reaching $48.8 million. This increase is mainly due to higher payroll costs, including some payouts when people leave and stock-based compensation, which is like paying employees with company stock. Because of these lower revenues and higher expenses, Geospace actually reported an operating loss for the year. They lost $11.3 million. This is a big change from the previous year, when they made over $7 million in operating income. It is important to note that in June of 2025, they sold a piece of property for $4.6 million. This helped soften the blow to their overall financial results for the year, but it is a one-time event. Now, let's dig into operating income by segment. The Smart Water division, despite its revenue growth, showed a lower operating income this year. That sounds like a problem, right? But the company says it is because they're spending more on sales, marketing, and research to keep that growth going. They also adjusted how they track manufacturing costs, which can make the operating income look lower, even if the underlying business is doing okay. The energy solutions segment, as expected, had a huge drop in operating income. It went from over $18 million to just about $400,000. This is a clear sign of how much this part of their business is tied to the unpredictable oil and gas market. And Intelligent Industrial still showed a loss, but it got smaller. So, while not profitable yet, it is moving in the right direction. Moving on to how they manage their money, their liquidities. At the end of September 2025, they had $26.3 million in cash. That sounds like a lot, but remember, they used $22.2 million just in day-to-day operations. This was mainly because of that net loss, but also because they had to buy more raw materials to make future products, which tied up cash. They also had a big cash inflow from investing activities, around $42.7 million. This came from selling short-term investments and some equipment. They are spending money on new equipment and buildings, but not a huge amount. Importantly, they have a credit line of $25 million they can tap into if needed, and they are not currently using it. Now, let's look at the risks. Geospace operates in some pretty tough markets. The oil and gas industry is incredibly volatile. When oil prices drop, companies stop exploring for new reserves, which means less demand for Geospace's seismic equipment. This is a huge risk for them. They also talk about the war between Russia and Ukraine. While they sold their Russian operations, they still buy some things from there. and any trade restrictions or tariffs between countries could make their products more expensive and hurt their sales. Competition is another big concern. They operate in highly competitive markets, and some of their rivals have way more money and resources. This means Geospace constantly has to innovate and stay ahead to keep its customers. They also mention that a few big customers account for a significant chunk of their revenue, especially in the oil and gas sector. Losing even one of these major clients could really hurt their financial results. One interesting thing is their business strategy. They are actively trying to diversify, meaning they want more of their income to come from areas other than oil and gas. They are investing in new products and looking to buy other companies. This diversification is key to reducing their reliance on the boom and bust oil market. Now, for my take on Geospace Technologies, they're in a tough spot with their core oil and gas business constantly battling market fluctuations. The good news is they're actively working to diversify into areas like smart water and industrial tech, and the smart water segment is showing promising growth. They are also making an effort to manage their finances conservatively, which is smart given the industry's volatility. However, the drop in revenue and profit for 2025 is a clear warning sign. The reliance on a few large customers and the intense competition are definitely risks to watch. Their ability to successfully integrate new acquisitions, like the Geovox deal, and continue innovating across all their segments will be crucial for their future success. It is a company with a solid technological foundation, but it needs to navigate some significant market headwinds and execute its diversification strategy flawlessly to truly thrive. Alright, that is our breakdown of Geospace Technologies' latest report. What do you think about their diversification strategy and the risks they face? Let me know in the comments below. If you found this analysis valuable, please give it a thumbs up and subscribe for more corporate deep dives. And don't forget to join our Discord community, linked in the description, for more discussions and insights. Thanks for watching, and I'll see you in the next one.